Welcome to Multifamily Insights. I'm your host, John Casmon, and I want to thank you for joining us for another great episode. If you are enjoying this show and getting some great value for your investing goals, well, let us hear about it. Leave us some honest feedback with a rating and review. It helps us, but also helps other listeners find this show for their investing goals. And listen, if you haven't done so, make sure you hit that follow or subscribe button so you don't miss an episode. Now, we've got a great show today. We're going to be talking to Daniel Cocca. Daniel Cocca is the co-founder and managing director of Alpha Investing, a real estate private equity firm targeting unique and compelling investment opportunities for the current market cycle and economic climate. Now, his background as a New York City big law corporate attorney, combined with his private equity expertise, gives him a unique viewpoint on structuring complex transactions, navigating capital markets, executing unique investment strategies, and managing multifaceted real estate deals. Let's welcome to the show, Daniel Cocca.
Thank you, John. I'll say first off, you have an amazing podcast voice. I wish I had it.
Thank you, man. I appreciate that. All in the genes, so mom and dad. So appreciate that there. Listen, Daniel, I went over your bio at a very, very high level. Why don't you take 2 minutes and fill in some of those gaps?
Sure. So by trade, I'm an attorney. I worked at a couple big firms in New York City. I started out as a capital markets lawyer, 2010, very unique time to be a capital markets lawyer, given the GFC. It was pretty wild, actually. Worked on a lot of high yield financings at that point in time. The IPO markets were effectively shut down, right? And there were some bank deals happening, but not a ton. We're doing just some creative financing deals for companies that were still trying to grow post GFC, and from there, as the market evolved, as it always does, did more bank credit deals, some IPOs, etc., but was primarily focused on the capital market side. Now, I always ran in a pretty entrepreneurial social group, and for me, I really always wanted to get outside the lawyer box, right? And as I think about kind of my path, that's the reason why, I ultimately moved over to the second firm, Goodwin Procter, that had a pretty much a top five. They called it a technology companies practice, but it's really a venture practice that, took some companies all the way through to IPO or acquisition, right? So I got into that space, met a group, brought in a client that was working in the real estate private equity world. At that point in time, this was shortly after the 2012 Jobs Act, and you saw a lot of these kind of first mover crowdfunders pop up. And there was actually a practice group within Goodwin Procter that was focused entirely on the crowdfunding space, right? So I had somewhat of a unique insight into how that space was evolving. I joined a company as the last kind of co-founder of the team. Fast forward, it's now two of us left. We bought out our partners, and we're effectively running a real estate private equity firm.
Hey, man, I love hearing that background. You talked about coming out as a corporate attorney, and you get really focused more on the capital market space during the great financial crisis. During that time period, a lot of creative deals for those who are trying to get stuff done, right? Banks weren't really lending as much. So you had a lot of experience working with these creative deal structures. As that started to change and deals started to become more and more available, you recognize that you were more entrepreneurial than maybe what that role was allowing you to do, made that transition to a different agency. And from there, you started to work on more venture-based deals. So that kind of got the blood flowing. Ultimately, you kind of enter into this partnership where you're one of the co-founders. You and your other partner are the two left after buying out your guys. And here we are with Alpha Investing. A couple of things, man. So I think one thing that stands out to me is you leverage the lane you were in to create this new opportunity. We talk to so many investors who just want to change completely. And it's such a missed opportunity to leverage the skill set you already have, what you went to school for and studied, what you were practicing for years. Figure out how you can leverage that experience in the next career of the future you want to get into, whether it's commercial real estate or whatever. But how do you leverage that? And that's exactly what you did. You started to surround yourself with more creative type deals, and that ultimately got you down this path. Can you talk about maybe that initial transition? Because you talked about kind of the stuff you were doing at GFC where it was more creative financing deals. I'm curious to hear like what you learned, and then as the market kind of bounced back, I might be reading too much into this, but I'm inferring that maybe you weren't as intrigued with the work you were doing as those deals became less creative, and you wanted to really flex and try to push yourself to be more creative. But you tell me, I don't want to put words in your mouth.
Yeah, sure. So, the not so secret is that being a law firm associate at a big firm in New York City is a miserable existence. You have usually at least 8 to 10 years where you're just grinding. I used to tell people, like, if I left work on the same day that I arrived, that was a good day, right? And, that's the reality of that space. And so for me, what that led to is this realization that, I'm being paid for the work that I do on an hourly basis. Any value that I create isn't going to me, right? It's going to someone else. And the reality is it's not really going to the law firm at all. It's going to, the bankers or the company that are pushing forward these transactions. And so in my mind, I needed to get on the other side of the table. And a really important turning point for me, there was this place in New York City called General Assembly. It was kind of like a venture startup, hub. It was a co-working space. They'd bring in speakers. And I went to this panel. It was, lawyers who now work in venture capital, or who are now, on the business side at, early mid-stage companies, right? And I think there were 4 lawyers on the panel, and every single one followed the exact same path, which is I worked at a big law firm. I transitioned to an in-house counsel role. Over time, I got to play more of a business role. Maybe I went to a VC, maybe I found this other opportunity, but it took me like 10 to 15 years to get from lawyer to business side. And at the end of it, I'm an impatient person, right? And for me, that was just too slow. And I wanted to get there as quickly as I could. And so for me, when the opportunity presented itself to effectively be a co-founder of a company, that was the shortcut that I was looking for, so to speak. And it just so happened to be in a space that I had a lot of knowledge and ability to contribute, right? So I'm a deal guy at the end of the day. And so on the lawyer side, and so moving to, a real estate private equity firm where all I do is originate and put together deals was a perfect transition for me. Now, of course, when you're early and you're trying to minimize your costs so that you can put, as many dollars as possible toward, revenue generating activities, right? Having a lawyer who can review your operating agreements and basically get a transaction closed that you don't have to pay extra dollars for. That's a really valuable thing. And that's how I carved out my initial niche, right? I can come in and, be the guy that effectively manages the flow of these transactions. And at the end of the day, you can be confident that it's being executed appropriately, right? And, over the course of time, as I learned the space, I transitioned into, more of a business role where today I don't think I've actually reviewed a legal agreement in years, right? It's not the best use of my time. And so that was my journey. That journey is not necessarily something that works for everyone. There were, things in place in my life, like a lack of, family or, children specifically that allowed me to take some risks that, in my present state, with a wife and a young child, probably would not be willing to take, right? And so for me, I kind of felt the pressure, like if you're going to do it, you got to do it now. Every year it's going to get a bit harder. And that's what propelled me to take the leap. Secondarily, I just had a lot of folks in my network that were being very successful, starting, scaling, selling companies. And I knew I was just as smart as they were. I was just as capable. I worked just as hard, if not harder. And for me, it was really an exercise in developing the confidence to put myself out there. Right. And again, it's not for everyone, but for me, I wanted to at least take that opportunity. I'll tell you, my parents were like, "What are you doing? Like, you're a 5th or 6th year associate. Like, you're making a lot of money. You have a assistant, you sit on the 30th floor of a New York City skyscraper, and you're going to leave that to basically make $0. They did not understand that, but at the end of the day, I made a bet on myself.
And I love it. And I appreciate you giving us a little context, right? And that's something that, probably hit home with a lot of people. First of all, you were grinding it out early in your career. You're going to work hard. My wife was a consultant and, watched what that life was like for a long time, right? Lots of time on the road, lots of late nights. You talking about a good day was coming home the same day you went to work. I know that resonates with a lot of people, right? And recognizing, hey, you said this, and I thought this was super insightful. You said, it's not most of the time we talk about, hey, I'm doing this hard work and being billed by the hour, and I'm not the one that's really building up wealth. It's the company. You recognize it's not even the company, right? It's the people we're helping. It's the people on the other side of this transaction. They're the ones who are building wealth. So how do I get there? And it's interesting because I recall when I was in advertising, and starting out, I wanted to be an advertising agency owner. And then you start to go down the path, and it's like, okay, they're doing okay, but there's a whole lot of stress. There's a whole lot of process. But the clients on the other side, you look at the companies that are building these businesses and then now bringing you in to help with the advertising services, like those are the ones who are really growing and really scaling. So it's not that you want to necessarily own that agency, but if you could find a way to get on the other side where the real wealth is, that's where the opportunity is. You talked about being able to go to that panel. You're listening to these guys, all four telling you the exact same story. You recognize that there was a path to success and you took that, but you just wanted to compress the timeline. So that's what allowed you to go out there and seek those opportunities. I implore all of our listeners to think about that because there are proven track records and proven pathways to success. You just have to figure out how to leverage that step and leverage that process and then truncate that time frame. So many folks can help you with that. Listening to shows like this certainly can help you. But if you want to really accelerate your life, you got to be willing to learn what those steps are, truncate the time frame, and then follow that process. You mentioned the pushback too from your parents, right? Just recognizing what you were giving up. Can you talk about the confidence you had and what gave you the confidence to go out and walk away from, a big job in New York at a law firm to really this startup where it could work out or maybe it doesn't?
Yeah, I think it was a combination of things, right? And I wouldn't even say necessarily that it was confidence. There was an element of that, of course, like, hey, I see other people who are being successful in the space. I can be successful by putting myself out there. But at the same time, like, there was definitely some uncertainty, right? It didn't,
Yeah.
jump forward, with the belief that it was a sure thing. And the other path that I mentioned, the one where I work as a lawyer, I move at house, maybe I move to venture, maybe I, eventually get on the business side, et cetera, et cetera. That's a much safer path, right? You're generating, high salary during that entire time. You don't have to, go through the process that I did. I mean, there was a moment when we first started this company where, there were four of us, like, effectively living in a house in Manhattan Beach, in California, in LA, and I was sleeping on an air mattress for like a month at a time. And that startup life, I think when people talk about it, sounds really sexy and intriguing, right? And when I talk about it, from a nostalgic perspective, it's fun, but at that moment in time, it was not, right? It was
Yeah.
pretty miserable, right? And you have, the positive to that though, and this is something that's always been very motivating for me, is that you really have your back against the wall, right? There's no retreating. The ships have been burned. You have two options, right? You either, move forward or you quit. And, for a lot of folks like myself, I like that pressure. I work well when there's a lot of pressure in terms of, performance. If, I'll tell you some of the worst times for me in terms of just productivity and efficiency, were like end of 21, where rates are so low. We're selling deals for, 150 plus basis point cap rates below what we bought them for, what we expected to exit at. And it's just easy. That wasn't the best time for me. The time that I like, times like now, where, we got to grind, we got to put together deals. And that's just kind of part of my internal DNA, right? Reason why I even made it as long as I did in the law firm environment is because I like to grind. There's a satisfaction in that for me. And so, yeah, to answer your question in a fewer amount of words, I believed I could do it, but I certainly had doubts about how quickly it would happen, what the path would look like, and some anxiety around like, what does this look like, right? What if this doesn't work out, right? And I'm sitting here in 2 years, and I just kind of like stepped away from a sure thing, so to speak, and now I have to refigure out my life, right? That being said, we're 10, 11 years, into the future now. It has not all been, a smooth ride, right? Particularly in this current environment, it's been very, very challenging. And so, it's all to say, everyone has to make their own individual decision. Is it something that you really want to do? Is it a space where, you think you can devote the energy needed to be successful? And if so, take a chance.
I love it. Daniel, let's talk about the market, right? So, for you now, when we think about investing, market conditions have certainly changed from when you first started getting into this space. Talk to me about your approach investing in uncertain markets.
Yeah, it's a really good question. We were always like long-term fixed rate debt, cash flowing acquisition guys, and we're private equity, right? So what we're going to do is we're going to partner with an operator that is hyper focused on an asset class, a strategy, a handful of similarly situated markets, and we're going to try to leverage their, expertise in acquiring assets, right? And so as the market shifts, as the economy shifts, we're able to be fairly flexible and nimble in terms of how, we move around, right? So in 18 or 19, for example, we were doing a lot of these heavy value add deals because you could spend 20, 25K a unit. I'm talking about multi and push rents, $300 a month, sometimes north of that, right? And rates were so low that you could justify those strategies. That same strategy today makes zero sense, right? And we've since kind of shifted. And so I think from my perspective or the firm's perspective, what we're constantly trying to do is take a look at the larger market, the macroeconomic data, and say, this is a strategy that we think makes sense. Let's find partners that are focused on only this one thing, and let's deploy capital there. Let's leverage their expertise. And then over the course of time, as those markets change, we will effectively shift to other strategies. And that's really what we've done over the years.
Daniel, I love that, man. You said a couple things. And one, you're talking about being private equity, right? So you're not necessarily the boots on the ground doing the day-to-day operations. So you're making sure that you've got a sound investing strategy based on both the macroeconomics and also that on-site operator who really understands that space. And that's the strategy you use. You talked about, hey, back in 1819, value add multifamily heavy lift deals made sense, not as much today. You're constantly kind of evaluating that. So for our listeners who are looking to invest, I want them to try to think like a private equity firm would think when it comes to making these investments. First of all, let's go back to what you see in the multifamily sector. Obviously, interest rates have increased, but you mentioned those deals don't make sense today. Can you just give us a little more context on what you see, why it doesn't make sense today? And you talked about the deals and talk a little bit more about the deals you are doing or that do make sense in today's environment.
Yeah, I think there's two parts to it, right? One is that we are cash flowing acquisition groups for the most part, right? And you need to have positive leverage when that's your thesis. And so, buying a 5.5 cap with 6% debt at 70% leverage like doesn't work, right? You're not able to generate cash flow off those deals. And so, you know, it's not that the cash flow is necessarily changing anybody's life, right? Getting 5 or 6%, year one cash on a multi-deal is not moving the needle for most folks. But what it does is create a measure of downside protection. And that's why we ultimately like the cash flow. But as we think about our broader strategy, it's always been about value creation. But when people talk about value creation, the first place they always go is value add multi, right? We're going to renovate, we're going to push rents. And that's not really how we think about it. There are a number of ways to create value. And in different asset classes and different strategies, we'll approach that, concept in a different way, right? So, for example, when we buy senior housing assets, we buy a lot of independent living, assisted living, memory care facilities. A lot of times it's, buying at a high cap rate, off market deal. It's a very fragmented marketplace. Maybe it's buying a market cap deal or a marketed deal where you can move your NOI yield by 300 basis points through, more institutional expense management, right? On the multi side, we've been doing a lot of these tax abatement deals where, there isn't a value add component to the deal. Instead, the value creation is the tax abatement where, you're generating, meaningful NOI by simply putting this deal into a program. And what that frees you up to do is, take the, best return on investment upgrades you can make at the property, right? And so instead of effectively gutting every unit, maybe it's just quartz countertops, or maybe it's just hardwood floors, or maybe it's, putting washer and dryers in. And you say, okay, it's going to cost me X dollars to do it. And I think I can get 75 to $100 premium, right? Does the math make sense? Like, yes. Whereas, in 18 and 19, what you were doing is saying, I'm basically going to gut these units, and I have to because I need to push rents $300 to make this deal pencil, right? For us, we don't look at, we're able, I guess we have the luxury now to, really be micro focused on, what specific things actually make sense. And that what that does, or what these tax abatement deals do, is allow us to put our focus on that as opposed to really trying to push rents. And in this current economic environment, I know there's a lot of uncertainty in terms of what does the economy actually look like now, right? So we track the jobs report, CPI, very closely. I also look at things like, personal consumer finances, so credit card debt, savings rate, auto loan delinquencies, mortgage delinquencies, right? And when we look at all of those things, we're at or near historic lows, really across the board. And despite that, there still seems to be this narrative that the economy is really pushing forward. And when you take a deeper dive into the jobs report and CPI, I think you can come to a slightly different conclusion than what's being pushed in the media, right? And the reason I bring this up is that the strategy of trying to push rents, even to 250 a month, it doesn't seem all that smart if you believe you're going to have increased delinquency going forward, right? And so a strategy where your value is being created at acquisition, through a tax abatement strategy, that's more appealing to us. And then the last thing that on multi that I think is interesting right now would be, high pref or pref equity in deals where you still have, your last dollar in is not, 90 or 95 or 100% into the deal, right? It's not rescue capital. It's a deal that for whatever reason doesn't make sense to exit right now, probably because rates are high and cap rates are fairly high as well. And, because of that, you want to hold, maybe you want to refi into, longer term debt, you have a maturity coming up. There are a number of reasons why a deal that is in good shape, needs a few $1,000,000 of pref equity to move forward. That's a strategy we also like as well. There's obviously not as much upside in those deals, but you can look at a project like that and really have good downside protection. If you're able to generate, 8% current pay and then maybe up to a 15 IRR being in a pref position, that's interesting to us in this market. Now, if we talked 4 years ago, we'd be having a different conversation. If we talk 2 years from now, we'll be having a different conversation. It's a really big part of what we do. We are looking for, investment opportunities that make sense today. And, given the fact that we are not an operator who's spent their entire career in one space, we can be pretty flexible and nimble.
Daniel, I love a lot of what you said. And I think it's really important for people to process the strategy behind the tactics. So, one thing you said a couple of times, and I want to reiterate it, you talked about being a cash flow acquisition group. And what you alluded to and said more directly later on was that you're focused on investments where you have great downside protection. And when you're focusing on that, you're looking at the loans, right? You like fixed rates. You don't want to have a whole bunch of variables in there. You want operators who really understand that market. You're looking at deals where there's value to be created, but not necessarily big renovations, right? So you're trying to figure out, well, what value makes sense today? It's not to say that, hey, we're cash flow, so we're not concerned with depreciation. No, you're saying, hey, we want to look at deals where we can still create value, but our cash flow is there out of the gate and we have some great downside protection. So now you're looking at tax abatement deals. You're looking at deals where maybe the leverage or the loan situation is more favorable. You talked about senior care investing, where this is a more fragmented segment, so you can maybe ladder those deals up and have a little bit more value just through the scale. So I love the strategy because even though the tactics seem to shift frequently, the strategy and the investing thesis did not. And I think that's really important because I think people lock into the tactical side. Hey, we buy value add multifamily, we renovate this, Class B apartments, whatever it is. But other metrics start to change, and that strategy may not make as much sense. And they've tied the strategy with the tactic as opposed to treat them as two separate ideas. So I love the fact that you clarified that. Can you talk to me a little bit more about how I know you talked about the economics that you're tracking, but how frequently are you making adjustments to your investing strategy or deciding that, hey, you know what, investing in, heavy value add multifamily deals doesn't make sense now? Like, what is that process to make those determinations?
Yes. So, we have our internal kind of team calls, every Friday. And a part of that team call, and this is everyone from, my co-founding partner, all the way down to the associates and analysts, right? That are effectively saying, hey, this is what I'm reading. This is what I'm seeing. I think this is interesting. We should explore this. The reality is, I spend a lot of my time exploring strategies that turn into nothing, right? I spent a lot of time, at the end of 23 into 24, looking at single tenant, triple net lease deals. I thought, okay, you can buy something at an eight cap, maybe higher. You buy something with less than 5 years of term on it. You extend, the lease, create a bunch of value. Maybe you exit in a year or two, cash flow for a little bit. Those are interesting. And in that 6-month process that we were really vetting that strategy, because for us, before we act, before we put a strategy in front of our investors, 6 months to a year, where we're really trying to hone in what that looks like, right? That strategy changed. Cap rates came down a bit in the space. Availability of financing as rates started to go up were a bit more challenging, less 1031 capital, et cetera, et cetera. And so that's a long way of saying, as we try to look at these strategies, we're always looking, but we're also never looking, right? And so if a new deal isn't interesting, like, we have no pressure to move forward. And the reality is, the way that we structured our firm, we do relatively few deals a year, right? Like maybe 5 to 7 in a normal year. Like when we were talking about 2020, we didn't pull the trigger on anything until August, and it was an affordable housing deal where 100% of the rent was guaranteed by a city housing authority, right? So a very low risk transaction, because we didn't really understand what was happening in the space, right? And to be honest, my gut reaction with COVID is that we were going to have much more immediate pain on the delinquency side. And of course, when you print trillions of dollars of money, that changes things, and the market went on somewhat of an epic run, right? It's, we're being caught up now in terms of what's kind of been happening over the last 2 years since we got into the rate hiking cycle. But that's all to say, um, when we evaluate new strategies, they have to check certain boxes, right? You're not going to see ground up development deals from us, right? We're looking again for strategies and opportunities that are a bit more compelling. We are not capital allocators anymore. I think there was a moment in time where we thought of ourselves more like capital allocators. And I think that trend across private equity is much more prevalent now, which is, okay, if you're going to actually buy into a real estate asset class and strategy. You have to also be operating it, and you have to have a way to create some type of value. Again, that doesn't always mean, renovation, right? But it needs to be, more compelling than I'm going to buy an apartment building and we're going to put a third party manager in and, we're going to get lost to lease and, we're going to create value that way. That works in a good market, but in a bad market, you have to be more creative. And so for us, we're trying to find operators and strategies where we think we can check all these boxes. And I don't think I could find 30 of those deals a year, if I'm being honest. And that's why 5 to 7 is a normal year. We have a deal closing next week. We got another one in the pipeline. I think 5 to 7 this year is probably a fair target for us.
Daniel, I appreciate that, right? You talked about the weekly calls, and through those calls is where you uncover interesting ideas and strategies, and many of those never come to fruition for various reasons. But having those conversations keeps you and your team in tune with the market and allowing you to evaluate what makes sense based on your strategy. And I absolutely love the focus on creating value without sacrificing the focus on cash flow. For folks who want to learn more, you can go to alphai.com for alpha investing. Again, that's alphai.com, and check Daniel and his team out there. Right now, we're going to transition and go to our round of insights. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmoncapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to casmoncapital.com and click on the mastermind button today. Daniel, give me a failure or an apparent failure that sets you up for later success.
That's a good question. So when I think about immediate failures, we, like a lot of folks, probably over-acquired multi during 20 and 2021, right? And we departed from some degree from our long-term fixed rate debt strategy and said, okay, we're going to buy with floating. It makes more sense. We're going to get out of these deals inside of 18, 24 months. We're going to buy rate caps. So, we've effectively, created a fixed product, right? And what that didn't anticipate are 2 things: how quickly, rates rose, which I'm not sure anyone, anticipated that would happen. But then also the challenge that you would have if you needed to hold on to that deal for 3, 4, 5 years, right? Because what happens is your rate cap expires, right? You have to buy a new one. Now they're very expensive. They were dirt cheap in 2020 and 2021, right? Now you're spending $1 million plus for a 12-month rate cap with a relatively high strike price, right? And so that has reaffirmed what our strategy really has always been, which is need-based residential housing, value creation, and deals that are capitalized and financed in a way that does not create a ton of short-term pressure, right? You don't have to create a ton of value in 6 months or a year and look to sell the asset in order for the investment to make sense. These are longer term holds. In our case, most of these deals are underwritten for 5 to 7 years. And I think, this moment in time, even though it was a relatively small percentage of our portfolio, maybe like 12 to 15%, where we employed this type of strategy, right? The work that it has created today in terms of operational challenges. And we have our own internal asset management team, right? That has access to all the financials. We're on, and for some assets, multiple times a week calls, trying to drive strategy. When too many dollars are going to service the mortgage and not to the property, it creates this whole slew of issues, right? That then makes what should be a relatively simple thing, stabilizing a property, much more challenging, right? And then on top of that, you have to find new ways to bring in capital, right? Whether it's a capital call or pref equity or what have you. So the amount of my time that's spent putting out fires as opposed to actually trying to create value for those specific assets has increased, dramatically. And as we think about how we want to be positioned going forward, it's much more about getting back to the long-term fixed rate debt. Let's buy assets that we think are at a price that makes sense today. We are going to make very reasonable underwriting assumptions as we move forward. And we're going to be positioned to hold this thing 5, 7, plus years if needed. And I very firmly believe, pick any moment in time. Buy an asset today, 7 years from now, it's going to be worth more than you bought it for. 2 years from now, it may not be, right? 5 years from now, maybe. 7, 10 years, absolutely. Like, it's just the way that it goes. And so, for us, basically setting ourselves up to hit singles and doubles, and then being flexible enough when market conditions change to exit a deal or acquire an asset at a great basis, meaningfully under appraisal value. That's where you turn that single or double into a home run, as opposed to trying to manufacture it by capitalizing your deal in a very specific way.
Give me a digital or mobile resource you recommend for our listeners.
Every morning, I start my day the exact same way. I read the Wall Street Journal every single day, typically on my phone, obviously. I don't know if people actually read physical newspapers anymore, but I start every single day. And the other thing that I do a lot of, I'd say over the last 2 years, I listen to a lot of podcasts. So, but podcasts that are hyper specific. So, for example, The Rate Guy. I'm sure a lot of your listeners are familiar with him. I love his insights on what's happening in the rate environment, and it's usually like a once a week show, give or take. I take that oftentimes back to our team and say, hey, like, are we thinking about what's happening with rates in the same way? How did we look at the last jobs report or core PCE or CPI, and what decisions are we making, and let's discuss it in the context of what this guy is saying, right? The Rate Guy also did his undergrad at Penn State, and so did I, and so I'm a little bit biased. But that aside, those are the things that I think kind of drive the way that I try to use digital mobile resources, in furtherance of our investment strategy.
You talked about reading there. Give me the book you've recommended or gifted the most in the last year.
So the one book that I absolutely love and has nothing to do with real estate or finance is How to Win Friends and Influence People. I absolutely love that book. And for me, it was particularly useful because you have to picture a young 24, 25-year-old Daniel coming out of law school, thinking he's like a real big deal, right? And really knowing like my stuff, numbers, head down, I can work 100 hours a week, I'm going to crush it. And not really paying attention to the people side. And, as I got older, there are a few very, key people that I met that I would say were almost the opposite of me, in that they knew very little about the underlying business or structuring transactions, the minutia, the detail, what have you. But they knew a lot about how to engage with people. And for me, that's really the most valuable thing here. And as a lawyer, a lot of times people say, how do you structure deals so if something goes wrong, you're protected? And the answer I always give is, I partner with the right people. I spend a lot of time trying to find the right people. If a deal goes bad or some other, business transaction goes bad, if no one's ever done this before, the process of suing someone, taking them to court is miserable. And what does not happen at the end is the judge doesn't say, Daniel, you were right. This guy was wrong. You win, he loses, here's $5 million. That's not how it works, right? You spend 2-3 years like just in the sludge, like it's super frustrating. So for me, really picking partners that I think we want to work with, not just on a business perspective, but also a personality perspective, is incredibly important. And then as we engage with those folks, really just being fair players. I always tell new folks we talk to, in terms of who we would partner with, JV with into deals, I always ask, like, first call, can you send us over, your usual structure? What are your terms? What kind of waterfall do you want? And my response is always, the reason we're not going to get there isn't going to be because of our terms, right? We're going to look at deals and we're going to come to terms with something that we think is reasonable and, values the fact that not only are we bringing a meaningful amount of capital into these deals, but we're also devoting a significant amount of both acquisition and asset management, resources, right? But if you approach it that way and the operator or your partner does so similarly, it's a really easy way to say, okay, like this is a fit. There's a qualitative element to this that I would argue is much more important than the quantitative side.
Give me a daily habit that helps you stay focused on your goals.
For me, I need to be active every day to start the day, every single day. My one off day is Saturday, and I'll tell you it's probably my least favorite day of the week for that reason. There are two things that I do actively. One is just general kind of workout, hit the gym, what have you. But every Monday, Wednesday, Friday, from about 6 a.m. to 8 a.m., I play pickleball. It is my favorite thing to do. I didn't have a racket sport background. I was a baseball, basketball player growing up. And what it provides for me is two things. One, the ability to really be competitive with something outside of work that's also physical. And then to actually get better at something that I didn't start out, already being good at, right? It's very hard to refine your skills. Like, okay, I'm a lawyer, right? How do I refine my legal skill? It's a very long process. And the reality is, like, you're probably not moving the needle all that much over the course of time. But, in a physical sport, particularly where I knew nothing about, the fundamentals of shoulder, elbow, wrist movement, what have you, I've been able to see that progress over time. And for me, that's a really rewarding and satisfying thing.
Give me your number one insight on investing based on cash flow while still looking for value.
Well, I guess my number one suggestion would be patience, right? And it's a hard thing to do, right? I'll tell you, it's like with all investing, right? Like you want to act now and you want to get the win, but you really need to be patient, right? And part of the reason why we really like the senior housing asset class, which is probably the asset class we're most bullish on right now, is that we can sit and circle a deal for 3, 4, 5, 6 months, right? There are very few buyers in the space. And because of that, deals go under contract, but then it's a first-time buyer and they can't navigate the debt or equity capital markets, deal falls out, right? Deal was under contract at an 8 cap, maybe we get it for a 9.5, right? We could have bid aggressively and we could have made that deal pencil at an 8 cap, most likely, right? But the ability to really be patient and look at a market and say, okay, this is a space where the buyer is in a more favorable position, right now. And we don't have to be ultra aggressive to get deals, right? We saw this during like 20 and 21 on the multi side, like everyone just bidding cap rates down, seeing sub 3 cap deals, right? That's because everyone's being really competitive about how are we going to acquire this deal? We want this specific deal, or we need to be acquiring right now. So there's a ton of capital in the space. For us, the approach is let's be patient. Let's let deals come to us where, I don't want to say they're no-brainers. We obviously spend a lot of time underwriting and evaluating deals, but where it's not about how do we make this deal work? It's this deal works.
I love it. Well, let's lighten the mood and go to a different direction, right? So from New York, you spend a lot of time in New York. I know you're out in New Mexico now, so I'll let you pick the location, but give me your favorite place to grab a bite to eat.
Oh man. So let's go back to New York City because I live in both an actual desert and a food desert right now in New Mexico, though I do split my time between Albuquerque and Nashville, where our company's headquarters. There's a lot better food options there. But in New York City, one of my favorite restaurants, it's a small Italian shop in Flatiron. It's called Resdora. And there's a very well-known restaurant in Modena, Italy called Osteria Francesca, which is usually on the Pellegrino top restaurant list. And the executive chef there came to New York, made a relatively small restaurant. It's kind of hard to get into. There's probably less than like 50 seats in that whole spot. And it's my absolute favorite place. I spent during the early, probably like 2021, I probably spent a few months trying to the favorite dish that they serve there, which is a ragu modanaise, which is similar to a bolognese, but with ingredients from Modena instead of Bologna. I spent probably 3 months perfecting that dish. I make it at home all the time. I have spoiled my 2-year-old son in a way that he does not realize yet. Like he does not eat, Prego sauce out of he gets, his ground pork and prosciutto de Parme and mortadella, in his sauces. And so that's my spot. I love it. Whenever I'm in New York, which is often, it's my first go-to.
I love it, man. Listen, anytime you're so infatuated with the meal that you replicate, the meal yourself at home, it's got to be good. So I love it, man. Sounds like a great place to try to get an appointment and try to get on that calendar to get some meals there. Great stuff, Daniel. I really enjoyed your conversation. You talked about your background working at Big Law and making that transition to being more entrepreneurial and taking the leap of faith there, recognizing the success that others have had, taking that same footprint but truncating the time frame. And talk to us about your approach and your thesis, right? Focusing on those cash flowing investments, cash flow acquisition, while still looking for value and recognizing that it doesn't necessarily mean that you have to do value add multifamily. You could look for, tax exemptions or tax abatements. You're looking at senior care facilities, looking at other ways to create value while still relying on that operators to go out there and actually execute. Lots of great information for our listeners to take in. So I appreciate you sharing that with us. Again, for folks that want to learn more, they can go to alphai.com, which is short for Alpha Investing. Again, that's alphai.com. Daniel, thanks again for being a great guest and coming on Multifamily Insights. We look forward to staying in touch with you, and I hope you have a great day.